Think the best investment opportunities are only in your home country? Think again. In this video, we're unpacking investing across borders. What you need to know about international stocks. You'll learn how to diversify globally, manage currency and political risks, and tap into growth from markets you may have overlooked. Today, we will talk about investing across borders, what you need to know about international stocks. So before we get started, make sure to hit that like button, also subscribe to my channel. 1. Investing in international stocks means putting your money in companies outside your home country. When most people start investing, they often focus only on companies from their own country. This feels familiar and safe. But some of the world's strongest companies and fastest growing markets are located overseas. By investing in international stocks, you gain access to more opportunities. It allows you to own parts of companies from Europe, Asia, Latin America, or Africa. These companies might be leaders in energy, technology, manufacturing, or agriculture. Investing across borders gives you a bigger world of choices, which can lead to better returns over time. 2. International stocks help you spread your risk. When your investments are all from one country, you're depending too much on that country's economy. If it goes into a recession or faces political trouble, your whole portfolio can suffer. But when you invest across different countries, the risk is spread out. If one country struggles, others may still be doing well. This is called diversification. Global diversification helps protect your money and smooths out the ups and downs of the market. Even if your home country faces economic problems, international stocks can help balance your total investment performance. 3. Some of the world's best companies are not based in your country. You might be surprised how many top brands and market leaders are based in other parts of the world. Think about car manufacturers in Germany, technology firms in Taiwan and South Korea, luxury brands in France, or consumer goods companies in Japan. These companies are well known globally, have strong earnings, and often pay reliable dividends. If you only invest in domestic stocks, you're missing out on some of the most stable and profitable companies in the world. Investing internationally means you can own parts of these businesses and benefit from their global success. 4. Emerging markets offer high growth potential. Emerging markets are countries that are growing quickly but are not yet fully developed. These include places like India, Brazil, Vietnam, and parts of Africa. These countries often have younger populations, rising incomes, and expanding economies. That creates demand for more goods, services, and infrastructure. As businesses grow in these countries, investors can benefit from strong returns. However, emerging markets also come with higher risk. Their stock prices can be more volatile, and political or economic instability can impact performance. But for long-term investors, these markets offer exciting growth opportunities. 5. Currency changes affect international investments. When you invest in a company in another country, you're also exposed to that country's currency. For example, if you buy a stock in Japan, the value of the Japanese yen compared to your home currency will impact your return. If the foreign currency becomes stronger, your investment may be worth more when converted back. If it weakens, your return might shrink. Currency risk is an important part of international investing. It adds a layer of complexity, but over the long term, it can also create opportunities. Understanding this helps you make smarter global investment decisions. 6. Political and economic conditions play a big role. Different countries have different laws, tax systems, and levels of political stability. Some countries are very business-friendly, while others have more government control or corruption. Political decisions, such as trade policies or interest rate changes, can impact stock performance. Economic growth, inflation, and employment rates also affect stock values. That's why it's important to research the country before investing. It's not just about the company, it's also about where that company operates. Being aware of the bigger picture can help you manage risk and make more informed choices. 7. You can invest globally through international ETFs and mutual funds. You don't have to buy individual foreign stocks to invest globally. There are many mutual funds and ETFs that focus on international markets. These funds hold a mix of companies from various countries, giving you wide exposure with a single investment. Some focus on developed markets like Europe and Japan, Others focus on emerging markets like India or Southeast Asia. Some funds even target specific regions or themes, like Asian tech or Latin American banks. These options make it easy to add global exposure to your portfolio without the stress of choosing individual companies. 8. Investing internationally can boost your long-term returns. By adding global stocks to your portfolio, you open the door to companies and markets that might outperform your local market. Some countries grow faster, some have strong trade advantages, and others are rich in natural resources. Over time, these factors can lead to better investment performance. A mix of domestic and international investments often leads to higher returns with less risk. Even small exposure to foreign markets can make a big difference in your long-term results. The key is to be patient and let your global investments grow over time. 9. Taxes and regulations may differ when investing abroad. Each country has its own tax rules and investment laws. Some foreign stocks may come with extra taxes, such as withholding taxes on dividends. You might also face different rules for reporting foreign income or holding foreign assets. In some cases, foreign companies don't follow the same accounting standards as companies in your country, which makes it harder to compare performance. When you invest internationally, it's smart to learn about the basic tax and legal details involved. Using international ETFs and mutual funds can often reduce these complications because the fund handles most of the compliance. 10. Start with simple exposure, then grow your international portfolio over time. You don't need to go all in on international stocks right away. A good way to begin is by investing a small portion of your portfolio in a global fund or ETF. Over time, as you get more comfortable, you can increase your exposure and even start learning about individual international companies. Keep your strategy simple, focus on the long term, and stay diversified across countries, sectors, and industries. As global markets evolve, having international investments gives you more ways to grow and protect your wealth, no matter what happens in your local economy. Investing across borders helps you tap into the strength of the global economy. It lets you go beyond local companies and find opportunity in fast-growing markets, strong foreign businesses, and global trends. While there are risks like currency changes and political issues, these can be managed with smart planning and diversification. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.